All right, Robert, buying a home is now a lot more, significantly more affordable.
Well, you have more mortgage variations available to you and an expanded high ratio um, marketplace than we ever had before. So that's either good, tremendous, or too little, too late.
Well, depending on where you're at with your real estate journey, on this episode of Real Estate Chat with Robert Eid, and
Jonder Perez.
we're going to tell you, and perhaps you'll be thankful for this, perhaps not, the Canadian government, what they've done to make things quote unquote affordable. And so, of course, what we're talking about this week, and every realtor has already been buzzing about, and we're going to dissect it on this episode of Real Estate Chat. Make sure you like and subscribe so that you don't miss any episodes. You can tell I'm so excited about this. Is the changes that they've made to both the amortization period of mortgages for first-time buyers, which include resale and new construction, and also the amount. So what's interesting, Robert, is that they made it more affordable. Maybe that's the wrong terminology. They made it more accessible rather than affordable, even though affordability has been the issue. They've actually just said, you know what, instead of insured mortgages being just to 1 million, we're going to give it to you for up to 1.5. It doesn't necessarily make housing more affordable and makes it more, I guess, accessible that you can now get an insured mortgage up to 1.5. So first-time buyers, you can spend more money. And for first-time buyers as well, instead of 25 years, you can go to a 30-year amortization, which means not only can you take a bigger debt load when you purchase your home, you can also take longer to pay for it. Robert, how does that make things affordable? I mean, in terms, I guess they're not trying to make it affordable, but accessible, but it wasn't affordability the issue here in terms of housing?
Let's separate those two things. What are they trying to do, and what about affordability, accessibility? The extension of amortization to 30 years from 25 makes it, because you're paying it back over a longer period of time, the monthly payment lower. And because the monthly payment is lower, the ratio of the monthly payment plus taxes and half the heat to your income is now reduced. And so you don't need as much income to buy the same amount of thousands of dollars because the payment structure is spread over a longer period of time. Now, yes, of course, if you take longer at the same interest rate to pay something off, you're going to pay more interest, but your monthly payments will be lower. There's nothing to stop you at the end of the first 5-year renewable to say, okay, I've now got a new job. Instead of me renewing, so I'm on my second term of a 30, let's go to a 20. So I have as if I'd started at 25 and I've gone through the first one. There's nothing to prevent you from changing the amortization. What it's also done is if the average price in Toronto at 1.1 something or other, moving the price up to 1.5 as the maximum for CMHC, they're just acknowledging that Toronto and Vancouver are the most important real estate markets in the world, in Canada, rather. And so to have guidelines that are based on the average price or Sudbury price just doesn't make any sense. You've got to facilitate sales in Toronto and Vancouver. Now, what it does is reduce the down payment. Now, you are paying an ungodly, if you put 5 or 7% down, 3 point something or other percent upfront built into the principal sum as a mortgage insurance premium. Now, the mortgage insurance premium gets you that whole great big 97%, 93% mortgage at first mortgage rates rather than having to get a first and a second and a third, who knows what, at much more expensive. So all the way along, people have said, well, it's much easier to do the financing this way. And it depends on whether they want a second mortgage, if they're going to whack away like crazy, rather than paying the $42,000 insurance premium on a high ratio loan. But the down payment is reduced. So for individual people, this is going to change the market they're looking at. It used to be that people were shut out from buying 1.2. And so 1.2, if you had that for sale, you were in this dead zone of nobody can afford it. They need 25% down. They need 20% down. You can't buy it with 10% down. So each niche will be affected differently. If you're at 750, it doesn't make any difference to you at all. Now, new homes or buyers of newly constructed homes, doesn't matter whether you bought 17 before, this is also extended to you. But again, they're CMHC insured loans, which means you don't have a huge down payment. And the premium that CMHC charges for the privilege of insuring your mortgage and making sure that you've paid enough in a premium upfront so that they will never go bust if ever you can't pay it. It's a tickle. It's not a mind shake. It doesn't affect everybody, but for those that affect, it's a big change. That why didn't they do it more significantly? As I found out by watching CP24, they have a show on there. Al Sinclair from Remax Hallmark is on it. They got a mortgage lady on there whose name escapes me, and then they have someone from Tribute Communities made mention of it because he's got a special plan that they're pushing for Tribute new homes. Nobody's buying them, and so they're giving a special promotion, so good. But he also talked about the mortgage aspect, saying that if you come up for renewal from your mortgage and you want to move from lender A to lender B, instead of having to requalify plus the 2% stress test, you can just move it over to the second lender. So that facilitates people not being locked in and not being precluded from the portion or from the option to go to another lender when their renewal comes up. So everything is a little too late, but everything helps. Everything helps. Everything helps. Everyone, you talked about affordability. We talk about affordability as price. People say it's too high. Interest rates, people say they're too low. And family income, people say this is all I can earn. So we can't force family income up. We can't force interest rates down. They are trickling down. And prices, half of the people want prices to go up, half of the people want prices to go down. So guess what's going to happen? They're not going anywhere.
At least for the time being. But I mean, this is what's great about Real Estate Chat is because we like to put things into perspective and we like to challenge things. Now, Robert, correct me if my thinking is wrong, and I don't know how many of our Real Estate Chat viewers might be thinking this way, but because of these government programs put into place that allow from 1 million to 1.5, that allow from 25 to a 30-year amortization, from an economic perspective, doesn't that change now the demand for that range, as you mentioned, from the 1 to 1.5? Wouldn't there be now more demand and hence competition amongst that 1 to 1.5, and therefore pushing those prices upwards because now it's much more accessible for somebody to buy in that price range and be covered by CMHC insurance?
Yes,
So
of course.
instead of prices
course.
going down or being affordable, what these programs are going to do is increase demand for those particular segments and therefore push prices higher, which is counterintuitive, isn't it?
Okay. If you are in this, what was formerly a dead zone, you have a property that's going to sell for 1.5, 1 to 1.5. It's a dead zone because the mortgage financing changed. You needed a greater down payment. 950 was one thing, and 11.5 was entirely different. You need almost double the down payment. Anyway, so there's going to be an enhancement on a dead zone. So it's going to come back from the dead. Now, if you're looking at 2.5, it didn't affect you at all. If you're looking at 657, it doesn't affect you at all because you're already covered. You've already got the downstroke. You've already sold 7 houses. You already have a pile of money in the bank. So it doesn't affect you. What they're trying to do is correct errors. And the market in Toronto went up so that the CMHC maximum should have been 1.5 3 years ago. Now, if they had, would have made it worse? No, it was all about interest rates then. And we can go into the whole thing about what happened then, but there was a lot of spec buying in anticipation of there being a greater fool. This is a term borrowed from the stock exchange, a greater fool to come along and take that off your hands, irrespective of the earnings that rental property could, or the any of the fundamentals that would be behind an investment. So it's not counterintuitive, but it's again segmented. It makes a big difference in what was a formerly dead zone. And in Toronto, there are a lot of properties in $1 million to $1.5 million that have now become CMHC insurable. Now, some people don't want to pay $45,000 insurance premium, so it doesn't matter to them either. But they got to have the downstroke if they don't want to pay the premium.
Yeah, and we're looking at, I mean, beyond Toronto too, we're looking at, for example, 905 area where there is a considerable number of homes also sitting in that 1 to 1.5, whether it's, detached
Okay, well, when I
homes,
say Toronto, that's what I mean. I mean our whole
everywhere.
reporting area that we talk about, because if you want to pay $1.2 million, then you're going to decide whether you want to go to Mississauga or Richmond Hill or Pickering or go way, way north to Barrie because that's all the money you got. But you want to have a house and a neighborhood and a school and a community that fits into the price range that you can afford. So, as we've said before, there are busy pockets and there are dead pockets. Right now, there are also dead types of buyers, investors dead, first-time buyer, very wary, looking around, hoping to find something. And the buy-sell customer, he wants it to be fantastic on both ends. It's very difficult to do, but at least they're trying.
Well, this is intended, I guess, to get these first time buyers that are contemplating a move to now get off the fence and get in there. And because prices have remained stable, they're targeting that segment that's been dead, as Robert put it. And so doesn't change the fact that, you've got your budget. I mean, if you were disciplined enough to save up your 20% down payment, great. You don't need the CMHC insured
Right?
mortgages and all that
Yeah.
sort of stuff. So again, the push is to do what's right for you. I mean, don't buy into 1 to 1.5 if that wasn't something that you were going to be able to do and pull off financially to begin with. But the gist of it is, the way I at least, I look at it, is that all of a sudden this is going to ignite that segment of the market. There will be more demand in that market. Prices should push higher, and some of the 1.45, 1.5 will probably be bumped out of that zone. But the average price, as you said, Robert, at being 1.1-ish, there's going to be a flurry of activity all of a sudden because people will start
Well, with
buying
the
into them.
interest rates coming down, this is another one of these nudges, nudge, nudge, nudge. You get 5 nudges and all of a sudden you're running. That also, if you've saved up 16.5% down payment, where you thought you needed 25% because the maximum was $1 million. Now you got your 16.5 and it's incremental. You don't have to pay as much when you put 16.5% down as if you only put 10% down, as if you only put 5% down. The interest, the insurance premium varies with the size of your down payment. So go and investigate your situation. Whoever gave you a pre-approval before, go back to that individual and say, does this affect me in any way? And they'll say, yes, with the lower rate and with this, your down payment now can be leveraged to a higher price range or to a different price range or to in these 4 different ways that it wasn't available to be financed before. So find out the financing first. Go back. You can talk to a real estate broker who should know everything, but there's always some new wrinkle that's being presented to the mortgage brokers that isn't presented to the real estate because the mortgage brokers go to the real estate and say, hey, look at this. I've come to your meeting to tell you about this new fantastic thing. And so who knows everything? The specialist.
So make sure you contact a specialist. And if you have any questions about what we've just talked about, type it into the comments. We'd love to hear from you. We'd love to hear your opinion on these programs put in place by the government to help buyers get into the market and jump off the fence and finally start buying homes. Thanks for watching this episode of Real Estate Chat. We'll see you in our next episode. Take care and bye for now.
Bye for now.